So Nelson, I thought a good place for us to start in this conversation is maybe get Bradley just to outline the company for us. So essentially, Bradley, my understanding is that we've got two legs of the business, one that's focusing on payments infrastructure and another one that's really putting the services in the hands of the consumer. Can you just give us a broad outline of what the business is bringing to the market?
Sure. There is an underlying principle that combines the two businesses, and that is focus on financial services industry, with our primary client base being large financial institutions and small emerging financial institutions that want to enter the market in the provision of services to corporates and consumers. So our two businesses are payment infrastructure, which provides a lot of the payment infrastructure that you as a consumer would use when you use your debit or credit card when you go to a retail outlet. But concurrent with that, there's a whole host of things that you can do: get loyalty points, get rewards, get coupons, get vouchers, get discounts. All of that type of value-added services are the types of things that run on our infrastructure as well. And that is the differentiating component of what we do versus many others. So that's on the payment side of the business. We provide a lot of that hardware and infrastructure and capability and service to banks. On the software and services side, we have three legs of the business. Primarily, one is if you use an app, a financial services app, a lot of that is called digital channels. You engage with your financial services company through a digital channel. We do a lot of that development on behalf of the banks. The second is banks have a huge regulatory compliance burden that they have with the South African Reserve Bank, with the SARB and SARS, and all of that reporting needs to be done on a very regular and efficient basis. We do RegTech work allowing them to do that. And the third, which is one of the ones in that we hear about a lot, is cloud migration. So Amazon Web Services is an organization that we have a very close relationship with. We are the most advanced partner of AWS across Africa, and we help banks migrate the infrastructure into a cloud-based environment.
So Bradley, just if I can understand that, if I just looking at some of your customers, I mean, the likes of Capitec, Discovery Bank, Time Digital, Bank Zero, these are all the new incumbents.
Sure.
From what I understand, you provide almost a turnkey solution for their payments and requirements, for their regulatory reporting, and probably even for some of their back-end accounting. Would that be an accurate description of what you do?
It's partially correct. So what we do is we don't do the bank software on account ledgers, keeping track of all of that activity for them, but we provide them with the ability to do their reporting to regulators. We provide them with a lot of the capacity to engage with their clients and customers, whatever form that takes. And then we allow them to use merchant infrastructure to allow their consumers to engage with them. And those would be the components that we do. A lot of their technology and ledger accounting with new emerging banks are held in the cloud, as opposed to having a branch network, and that's what allows them to do what they do cost effectively. And that's something that we do provide.
So let's get straight into the numbers. If we take a look at the numbers that you shared today, a 52% growth in terms of payment terminals that you've actually got in the hands of the clients, but we are also seeing EBITDA down by 9.8%, and you explain it in the numbers in the context of strategic investments and expenditures that the business is looking into. Can you just elaborate what those investments are, and how do you see those in the long term bringing back the numbers and some of the profits that might have been eroded in this particular set of numbers?
Yeah, sure. That's an easy question. I think what you need to look at is our financial results in terms of giving 19% top line growth in this type of economy is a miraculous outcome. Why we had an earnings decline, there were two issues. One is we've got a very conservative accounting policy. We expense all of the things that we do on a periodic basis, as opposed to amortize it or capitalize it. So we started the business 2 years ago when we acquired it with 32,000 payment devices in the market. We have 140,000 payment devices in the market today. You can't do with the same office infrastructure and warehousing and production facilities with 140,000 devices you can with 32. So that's investment in infrastructure. We also needed to make sure that our business was sufficiently robust, that we had succession planning and new management in place, etc. And so we've hired a lot of people. on our payment services business, we're innovating all the time and developing new services. That requires some R&D. That's another thing that we've spent on. So those are the types of items that we have spent on. Over the course of the 2 years since we've had the business, we've added 100 people to our payroll. In a South African company today, that doesn't happen very often, particularly of a company of our size. So those types of things are investments, and they take some time to show themselves in revenue. But when you show 19% revenue growth, you haven't yet been able to catch up against those expenditures that you've expensed. So those are the types of things that we've done.
Just I think something that will interest a lot of investors. You bought back one of the founding investors, in fact almost 15% of your shares from this founding investor. If you could just give us some background on why this investor decided to exit the business at this stage of your growth, and how you intend finding another investor if you want one, or whether you're just going to cancel those shares.
Well, we certainly don't need to find another investor. We are now a public company. We have a distributed shareholder base, and we have lots of capital to be able to continue to invest. Professor Naischloss, who was the founder of African Resonance, is very focused on using some of the technologies that we use in DashPay in other emerging markets outside of Africa and elsewhere in the world, and wants to pursue those. He's a gentleman who is just celebrated his 70th birthday, and it was a natural migration for him to move on. We have a little bit of a different investment profile to the types of things that he wants to pursue, and we thought it was a perfect juncture for us to do that. We've also simultaneously, with the purchase of his shares though, acquired all of the IP that we use in our business from a company that he controlled. So now we absolutely control our own destiny in that regard, and we can prioritize development and initiatives and growth activities according to our agenda as opposed to some other agenda.
We've got just a little bit of time to squeeze in one, and I want to pick up on this comment of destiny, because if one begins to look at your client base, you make a note that the client base is diversifying, but you have almost all the banks in South Africa and other financial institutions as clients already. So in which way do we see future growth? Is it by deepening the offering to that existing client base, or is there a possibility that we might see you expand out of financial services as we know it, as you seek future growth opportunities?
So the answer is yes and yes. Retailers today are very focused on providing a service to their clients which has a financial services component to it, like Woolworths Financial Services, Pick n Pay, etc. We've started to do work with some of those retailers in our Amazon business, and will also do so in our payments business. In terms of the existing infrastructure with big bank clients, we'll continue to deepen our relationship, broaden that relationship, and follow them across Africa as they expand, which is a way of mitigating our risk for continental expansion.